In this chapter, we look at investment decisions based on net present value and internal rate of return. Most real estate decisions are made with an investment motivation, which means the magnitude of the expected cash flow from the property and the property values they create are at the center of the investment decision-making. The focus in Chapter 18 is on widely used, which talk about single-year return measures, ratios, and income multipliers. Those criteria are relatively easy to calculate and understand. It is a decided advantage in the eyes of any industry professionals. However, there are limitations on those single-year return measures and ratios because those measures do not incorporate the income-producing ability of the property beyond the first year of rental operation due to the expensive transaction cost for real estate properties. Investors usually hold the properties for a relatively long period. To overcome shortcomings of single-year decision-making matrix, many investors they also perform multi-year analysis of potential acquisition. When using this multi-year discounted cash flow analysis, the investors must first estimate how long she expects to hold the property, which is how many years she needs to focus for the future cash flow, and also make explicit focus on the property's net operating income for each year of the expected holding period, including the net cash flow produced by the sale of the property at the end of the expected holding period. After that, the investor needs to select the appropriate yield or the required rate of return at which to discount all the future cash flows. As an overview, what the investor needs to do is to estimate the holding period for this property and the net operating income from the property on an annual basis from operation, as well as cash flow from sales at the end of the period, and then discounted all the future cash flow to find the present value of those future cash flow. In this chapter, we use Central Point office building example to calculate net present value and internal rate of return. Total acquisition for this property is $885,000. The property consists of 9 office suites, 4 on the first floor and 5 on the second. The contract rent for the property is $1,800 per month for 6 of them and $1,400 per month for 3 of them. Annual market rent increase is estimated to be 3% per year. Vacancy and collection losses is estimated to be 10% per year of the potential gross income. Operating expenses is 40% of effective gross income. Capital expenditure is 5% of effective gross income. Expected holding period is 5 years. Expected selling price in year 5 can be calculated using the expected year 6 net operating income capitalized at 10%. Selling expenses in year 5 is $58,300. The first mortgage loan for this property is 75% loan-to-value ratio, which means the loan amount is $663,750. Annual mortgage interest rate is 8%. The loan term and amortization period is 30 years. Total upfront financing cost is 3% of the loan amount. With all this information, we will be able to calculate the net present value of this property as well as the internal rate of return. First, let's calculate the net operating income cash flow from operations for this property from year 1 to year 5. We have done the calculation for NOI in the previous chapter using the same example. Now let's look at how do we get this number again. So the potential gross income is income assuming 100% occupancy rate. The first year potential gross income can be calculated by the annual rental income for all the units of properties in this building. So there are 6 units with monthly rent $1,800, 3 units with monthly rent $1,400. We calculate the total monthly rent, multiply by 12, give us the total annual rental income, which is $180,000. The potential gross income from year 2 to year 5 can be calculated by increase the previous year potential gross income by 3%, which is the same increase rate as rent. Vacancy and collection losses is assumed to be 10% of the potential gross income, so we can derive this number from the potential gross income in each year. Effective gross income is calculated as minus vacancy and collection losses from the potential gross income. Operating expenses is assumed to be 40% of effective gross income, and capital expenditures is assumed to be 5% of effective gross income. We subtract operating expenses and capital expenditures from effective gross income. We will obtain net operating income from year 1 to year 5, the holding period cash flow. To calculate the net sale proceedings from sales, we need to calculate the expected sale price at the end of year 5. As given in the assumption, the expected sale price in year 5 can be calculated using a capitalization approach. We project the year 6 net operating income from the property using the same approach as the previous slide and divided it by 10%. Given the assumption, we will have the expected sale price to be $1,033,000. Selling expenses is given as $58,300, so we can calculate the net sale proceedings. The net amount of money we get from sale at the end of the property is $974,700. Now let's look at levered and unlevered cash flows. Levered cash flows measure the property's income after subtracting the mortgage payment. So the valuation of levered cash flows involves discount the expected before-tax cash flow rather than the stream of net operating income. Now let's calculate before-tax cash flow for this property. We know from the assumption the mortgage terms is 75% loan-to-value ratio, 30-year fixed-rate mortgage with 8% annual interest rate, upfront fee of 3%. We can calculate the loan amount is 75% multiplied by the property price, which equals to $663,750. Now let's calculate the monthly payment for this loan. Then the annual debt service will just equal to monthly payment times 12. Let's solve the monthly payment of this loan. So the monthly interest rate is 8% divided by 12. Number period is 30 years multiplied by 12. Present value equals to loan amount 75% of the property price. Future value equal to 0. So the answer for the monthly payment will equals to $4,870.36. Multiply this number by 12. The annual debt service will be $58,444. Because all the numbers in the cash flow analysis will be annual term. That's why we need to convert the monthly payment into annual debt service. Now let's estimate before-tax cash flow, the levered cash flow from this property. Before-tax cash flow equals to net operating income minus debt service. For example, in the first year, the net operating income is estimated to be $89,100. Annual debt service is $58,444, which gives us a before-tax cash flow in the first year will be $30,656.